on that topic, what are we looking at here? Let's go back to the beginning. We opened a Marriott put October 7th. Our underlying security moved up as we expected because the Marriott put is a bullish structure. SPY and QQQ showed the examples of rolling up the put. Now, what about in the opposite scenario? What about in the scenario when the position has fallen in price? Let's take a look here. I'm going to go back to the portfolio real quick. And we had entered in our SPY as an example, Kyle. But I'm going to go to the actual radioactive trading portfolio, 2024. Now, what do I have? There's the Planet Fitness position opened 16 days ago. Opened at 98.35. The stock's at 99.87. It's been as high as 102. I didn't roll the put up when I could have. I didn't roll the put up yet. I was only 10 days in. I wanted to generate some premium. I was looking to sell a call, and then it started to pull back. That's fine. It's in the wheelhouse. It's 1.5% up from when I got in 16 days ago. That's what I want to see. On, not so much. Opened this 2 days ago at 58.85. It's down $1.73. But because I used a really close 62.5 put, I took advantage of a cheap call just 14 days out. The stock's down 173. I've already made 43 cents on the call that I sold to buy it back, and I've made 120 on the put unrealized. So with the stock down 2%, I'm still at a liquidation value at midpoint of 0.1%. That's sort of the power of this technique. And then I've got pure storage here. And I have an income method number 6 on the position right now. Bought the stock at 56.96, currently at 64.92. Let's take a look at this profit and loss chart, Kyle, but wipe the slate clean. What I mean by that is that this is the position I'm currently in. It's still only a 3.8% risk. I have protection out 105 days. I've got my little riskless spread trade, my income method number 6 here on the position. Why this and not just selling the call at 70? Well, let's take a look at the chart for PSTG. PSTG was in the doldrums for a while. Remember, my cost base was around a lower value, right? It was just around where we're at right now. But this has been hanging out in the $48 range, $46 range, okay? Things of that nature here and there. Now, I want to do something real quick. What I'm going to do is let's go back to the custom spread for PSTG. And as I mentioned, let me wipe out income method number 6 entirely. Now here's a position with a 5.3% at risk, 105 days out. It's been much longer than that, Kyle. Bought the stock originally at 58.79. It's at 64.92, and I have the 70 strike put. Okay. Now looking at that chart again, there were opportunities along the way to do what? Let me go to a 6-month chart. Let me see if the drop's there. I think it is. Yep, there we go. So the stock sort of plummeted earnings. You can see why. Wanted to do a recovery and then fell again. So let's just go 15 and then the large rise back up here. Now we're in this position here. The stock falls, starts to come back up. I could have done something here. As it came back up, used the income method number 4 we just showed here. And as the stock fell again, done something here, and now come back up here. I'm going to focus on this area here at $48 per share. And we're targeting early November, mid-November, November 10th, November 11th, somewhere along those lines. We're going to use the historical view real quick once again. Sorry about that. And let's see. Let's close out some of these windows for us. There we go. Now, we're talking about PSTG. And I mentioned that we saw something that looked like it was about $48 per share or so back in November, early days. Let's try the 8th. 52.91. All right, so let me, next day, maybe it just touched it. It didn't close there. 52.60. I'm going to probably go with the 50. Oh, 50.15. Perfect. One more day. Sorry, guys. 49.87. We're stopping right there. All right, now, I had this position, 100 shares of PSTG, I'm sorry, 58.79. March 70 put at 15.10 for a maximum risk of 5.3%. Real quick, I'm going to add it to that portfolio we just created. December 6th. Here we go. Yeah, bye. And the date, okay, we'll go back to where we saw it, November, what was it, 8th? Yeah. All right, November 8th. Okay, so why am I doing this exercise? Because I want to show something related to Kyle's question in just a moment. All right, so now we have the pure storage position in. That's essentially at break even here. We bought it at 58.79. We've got the March 70 put at 15.10. It's down to $9 with time decay, and the stock is up. But what would have happened? Oh, I'm sorry. Was that in the March or May? I think I'm in the May. Oh, sorry, folks. No, I'm in the March. Fantastic. Okay. When the stock was trading at 49.87, what if I had sold that 70 put for a profit? It's up to 21.30 and bought the 50 put at 6.05. Another way to manipulate the put. What am I doing here? I'm taking $15 off the cost basis. The cost basis already includes the stock and the put. So I'm selling to close the 70 strike put and buying to open the 50 strike put for 6.05. I'm getting $15 off my cost basis. Now, this does work opposite of what we just showed with income method number 4, meaning that in this case, the put manipulation, I am getting $15 off of my cost basis in my pocket, excuse me, but I'm lowering my guaranteed exit by 20 points. Why would I do that? Well, naturally, to lower the cost basis of the position, to give myself a better break even if I'm still bullish on the stock long term. Okay? Kyle said, if the market fell 10% tomorrow, would you roll your puts down or leave them deep in the money? Well, number one, if everything falls 10% tomorrow, especially SPY and QQQ, Kyle, 10% tomorrow, I'm going to wait a little bit. I got to digest, why did SPY and QQQ fall 10%? Because that doesn't normally happen. Something else is going on. Some big news came out for that to happen. But even my stock itself, PSTG, it dropped 10 or 15% from earnings. Okay, I'm going to let it sit. I'm going to digest it. Why? Because when that did happen, in this case here, we fell from 60 down to about 52 and kept dropping. I want to digest the information. I want to look for my signals, the same signals I look for when getting into a Mary put, where maybe I'm getting back above that SMA 20, but more importantly, when I'm seeing a more positive MACD crossover, I'm seeing the bottom and the tail up. That's when I want to try to move the put down in this case. Then, when it breaches the next strike price, following the rules in the blueprint, we're going to go back up. Oh, but then we have a crossover and it comes back down. And then we have another positive crossover here. And that's when I'm going to look to move it back up. And then we have this jump here. Why am I going through this exercise? Because what I want to show, using those prices that we looked at historically, is back here in November when it touched that $49 era. And then we started to see the MACD crossover about 50, 52, but we're going to use that bottom. I know I'm cherry picking. What would have happened to buy in position, cost basis of 73.89, risk of 5.3%, when the stock was trading at that $49 price, and I was going to sell my March 70 put, remember it was at 21.30, and buy the 50 put for 6.15. So it was 21.30. I'm sorry, 6.05 was the midpoint. My apologies, ladies and gentlemen. 6.05. That's what my notes say to me. The 50 strike for March. Everything's all right. Now my cost basis has dropped that 15 points to 58.64. Now my risk went up. Why did the risk go up? Because instead of being guaranteed an exit at $70 with a cost basis of 73, I'm now only guaranteed an exit at 50 with a cost basis of 58.64. Why would I increase my risk in this faction if my goal is to see single-digit risks, to put the market odds in my favor? And it's because I expected a move back up. Now, like I said, I might have done it here when the stock pulled back above 50. But even right now, let's review. Not this position. I wanted this, December 6th portfolio. With no other income methods number done, remember, I'm at break even now with the stock at 64.92 because I've been in the position for an extended period. We just put 28 days in there from the purchase price of 58.79. No, that's right. That's right. So the stock's at break even at this point. It's nearing 70. I'm sorry. My apologies. I would have gotten a much different price. This is my position. Let me go back here. This is my position from 204 days ago. I've adjusted the put twice and rolled it further out in time. I apologize. So the 1510 wouldn't have been this price for the put. That was my price 210 days ago when the stock was at a higher price and much more time value, not 28 days. So that's why this doesn't look right. But let's use this as an example real quick. 58.79 cost basis, 1510. 73.89 total cost basis on the position, max risk of 5.3%. Right now we're at break even. In our other example, we rolled down to increase the risk to 14.7%. We took $15 of profit on the position to lower our cost basis. Now the stock's back at 64. Even though we simulated just doing this, I wouldn't have done it this way. But now what if I did the exact opposite? Now that the stock's back up, I'm going to buy a 70 put again, but I'm going to sell my 50 put for about only $1.15 and buy the 70 put. I'm moving it back up after the decline, and now that it's recovered, and I'm bulletproof at 5.4%. What did we just see? Kyle's question. If the market fell 10% tomorrow, would you roll your puts down or leave them deep in the money? 1, I'm going to hesitate, digest the information, because time is on my side. I don't have to overreact and do knee-jerk reactions with the market movements. Number 2, so wait slightly. Once I see, as you mentioned, Kyle, the confirmation discussed in the blueprint, what we look for with the different income methods, when we would do it, why we would do it, and what strikes we would choose, that's what's available in the full course. Then I would roll down. And then what does that do? Remember, that put me at that cost basis of only 58.30. It lowered it down, even though my risk increased. And then if it recovers as I'm expecting, doesn't always happen, Kyle, but if it recovers as I'm expecting, then 3, go back up. And did what? Same put I initially owned, where with my initial prices, we were at break even right now. But reducing the cost basis using income method number 9, and then moving it back up using income method number 4, I have 105 days left of protection in the position, Kyle. I have guaranteed 5% profit on the position, on a position that was almost near the full 5.3% loss. We saw it was 3.8, 3.9% loss when the stock was down in these ranges. Turn the loser into a winner using the income methods in the blueprint effectively. Now I'm in a bulletproof status with 105 days to go. And with all that being said, what could I do right now? Same thing that you'd want to do if you were in pure storage. You bought it at 58.79. The earnings were blockbuster. Went up back to 64.92. It was 20% gain, by the way, on the earnings. And then go ahead and maybe I could sell a call now. I could sell the 65 or 70 call, get this up to a 6-7% bulletproof status, 14 days to go to December expiration, still 105 days to go of guaranteed insurance. Okay. Yes, discussed in the blueprint, Kyle, full examples of when and why you would use the income method number 4 we just discussed. When you might want to stop using income method number 4, as we discussed. And of course, blueprint owners have members only webinars that go deeper into when to stop using income method number 4. Is it time to use income method number 9? Is it time to not use income method number 9?